Let's bring in Alan Ruskin of Deutsche Bank. Going to walk in right now. Let's look at the number while we bring in Alan. And you look at the number, and it's a simple number today. 1. It's a 1-year anniversary. This brought to us by Rex, helping out our producer. It's like a simplistic, it's like a Zen number. Nothing Zen in Europe right now, is there?
Unfortunately not, Tom. No. Lots of fires burning, really. Lots of focus on Greece, of course, Italian and Spanish debt, the banking system as a whole. So we're looking at a lot of different places.
Let's look 1 year ago. 1 year ago, ElErian helping out Gross. This was October 4th, 2010. Mohamed ElErian had joined us, and Bill Gross joined us from PIMCO. Here's Mr. Gross's prediction for the year to come.
A safe spread is basically not beta but alpha generation and high information ratios, as you suggest. And the objective is really to find that particular asset or asset class that generates a high level of income, a low level of risk, and a low level of volatility. The numbers would suggest that we've done that pretty well over the last 24 months. We look forward to it for the next 12 months as well.
And Bill Gross, a year ago, you could see him 3 p.m. this afternoon. Bill Gross with Lisa Murphy and Adam Johnson. Alan, what a year it has been. Bill Gross missing that sovereign move in yields. As you synthesize, as you do for Deutsche Bank every day, what do you explain to your clients linking economics to these dysfunctional markets?
Well, I think a lot of people have reverted back to the analysis that comes from some of the work that Com and Reinhardt did in particular. The Reinhardt-Rogoff model of post-financial crises and the considerable evidence that after these large financial crises, you see subpar economic growth on a pretty persistent basis. And that's exactly what we've seen in the United States. But I think we've thrown in another wobbly, as it were, to the extent that...
it's a cricket term?
It is indeed.
Is it perfect with John Ryding coming on? I love that. Continue. Wobbly. It's a very exclusive. Wobbly. First time ever on financial TV. Continue.
The European crisis has another dynamic. The problems in the European Monetary Union and the problems specific to the European Monetary Union have been, I think, a very strong and pervasive drag on global growth and now particularly on U.S. growth. So in many respects, you could say the underlying underpinnings, at least, of the U.S. economy are quite solid and not necessarily in line with double-dip recession. But when you throw in all the uncertainties that resolve and relate to the European story, right, then it, all bets are off, as it were.
Dreaded first chart. We make light of this. It's the 30-year bond. It's the new Ruskin 10-year yield. I mean, we've shifted the whole yield curve. Please explain to me the key distortion that we get from Operation Twist. I mean, there's got to be unintended consequences, like a 30-year bond trading where the 10-year yield ought to be.
Yes, I mean, there are some dangers that you get unintended consequences to the extent that, when you get past Operation Twist, maybe you get a backlash the other way. And, you're seeing some big distortions, I think, obviously, in the inflation expectation side as well. I think the issue here is, is there something that's going on that has a longer-term structural base? Is this a story of us evolving into a Japan-type scenario where long-term interest rates remain much lower for much longer than people anticipate?
Are you optimistic that we can avoid any portion of that decade-long plus malaise?
I'm reasonably optimistic to the extent that I think the policymakers in general are much more proactive, much more willing to use the tools that are there.
More so in the United States with Chairman Bernanke and others versus what we see in Europe.
Well, I think Europe is faced with some special constraints. So I think it's just aligning 17 different countries and getting all the different financial ministers even in the same room and then trying to get to agree on important things is quite tough.
Do you agree with Professor Rajan in Chicago that the IMF is that institution to line up 17 nations and we need a more assertive IMF?
No, I think it'd be helpful, and I think the IMF is trying to do what it has to do. The IMF, incidentally, is of course financially constrained as well, but I think it's much more than the IMF. The Europeans have got a particular European problem that they need to deal with.
Let's look at this chart. We showed it last week. I had to redo it thanks to John and everyone in the art department for yeoman's duty. These markets are so much on the move. That's 4 deviations now on copper off the trend out of 09. Commodities, and I love what David Kelly of JP Morgan Asset Management said today. Commodities have almost become an asset class. You used to trade them, off to the side, and somebody that, took a little more math than you did commodities. Now, for investors, they're an asset class. They're getting hammered here, aren't they?
They are, really, and I guess they're an asset class which is showing its volatility. And for new investors, I think this is going to be a learning experience. That this is high vol commodity and high vol asset class. What does Michael Lewis say right now? Michael Lewis out of your London office. What does he say? Well, I think the issue is really just again, it all comes back to the European story and what the European story means for global growth. And right now, it looks like we're going to see softening in European growth. We're likely to see softening in U.S. growth as the year proceeds beyond a decent enough third quarter. And, that does not bode well for commodities going forward. I mean, the other component that you have to consider, of course, is the dollar. The dollar is stronger, and dollar commodities are accordingly going down.
Very good. We are back. We need to make a correction. I said earlier that wobbly was part of cricket. I was wrong, as I was just told by Alan Ruskin and John Ryding. It's a googly, not a wobbly. And I still don't get it. Great to have both of you here today. John, what have you learned in the last 3 or 4 days about the U.S. economy?
Well, actually, the numbers on the U.S. economy have not been as bad as people were fearing. But what we continue to learn is the perceptions of the economy are not really what's driving the market. It's the market's attitude towards risk that's driving the market. And Europe right now is driving that attitude towards risk. So we've been in this pattern since the beginning of August, the S&P downgrade and the initial ECB refusal to buy Italian debt. And, we've continued down this path.
You were here a year ago. We now have greater dissent. I shook Richard Fisher's hand yesterday. He was in our world headquarters. Should the ECB cut rates right away? Why don't they come out and do something to shock the markets?
Well, I suspect that if they we'll get a decision on Thursday. I suspect they probably will cut rates by a quarter because it may be easier for Trichet as the outgoing ECB head to do it than to leave it to an incoming Italian at the next meeting.
Yes, I think it actually is. Just from the internal politics standpoint, it's a little bit easier to actually cut rates. And there's a little bit of an internal debate that we're having, but the economics team at Deutsche Bank thinks we'll actually get a 50 basis point rate cut. Right. That has been under challenge, of course, because of the inflation data. So, in my mind, the ECB is, in a kind of a no-win situation. If they end up not cutting, then the periphery's kind of tossed out on its own, and if they do cut, well, they've in some ways forsaken the inflation target.
Now, look at the two. Ask a question here of John Ryding. Have both of you on set is great. Alan, you're the guest host this hour. Ask a question here.
Sure, John. What do you think in terms of we're seeing that GDP numbers are actually being scaled up? From what I can see in quarter 3, I know a lot of people are forecasting at least 2% growth. There's a perception that quarter 2 and even quarter 1 was not perhaps as weak as the official data. What are you thinking in terms of, say, quarter 4 now, really, I think, which is really where we're at?
Well, I certainly agree the first half wasn't as weak as the GDP numbers suggest. In fact, you can look at the income side of the economy, and that GDP growth number was more like 2% than sub 1%. And while neither's a good number, 2 is better than 1, no doubt about it. And I think we'll be at about 2% on the expenditure data in the third quarter. So the fourth quarter, I think 2.5%. I think the temporary factors that were holding back the economy are diminishing, and we are not falling off a cliff. But all of that is a proviso that the European situation doesn't really blow up.
Yeah, well, where are we now in terms of blowing up? Here's a Bloomberg Financial Conditions Index, and I want to show it, folks. This is zero. This is stasis. Here are the good times. Here's the crisis. Here's Lehman. It's like a medical chart. We come back up, and it's really remarkably good. And Michael Rosenberg mentioned to me, gentlemen, we're 2 standard deviations to angst and to fear now. Where do we go from here when you blend in all the different spread markets? What do you see at Deutsche Bank on where we go from?
Well, I think a lot of this is really the angst that's reflected in the equity market. So it's an equity market indicator primarily. I think if you look at a lot of the different components in financial conditions, particularly on the bond side, you're going to get quite a bit of stimulus coming through there. Some additional refi that relates in part to the Operation Twist story. I don't like the idea that the exchange rate is looking like it's finally starting to appreciate substantially.
The dollar.
The dollar, exactly.
Right.
There you're going to get another kicker. And I think actually the dollar and equity weakness tend to be intertwined as well. The dollar actually tends to lead equity weakness.
Do you agree with that, John?
Yeah, and you know, the angst, particularly the equity market part, because all of this angst started when, after the S&P downgraded the US, the VIX, the volatility index of the S&P, almost touched 50. And that put it up there with the stock market crash of 87 and the failure of Lehman Brothers as the only two events which had seen larger volatility readings in the last 25 years. And, you know, things aren't great, but I really question whether things are really as bad as warranting a bear market in equities.
I'm so glad you bring this up, John. Alan, talk about this. I mean, Michael McKee's made a big point of this. There's some actually pretty good 1.5 macroeconomic advisors, 2.5% GDP statistics.
Exactly.
And yet, we're sitting here really trying to focus on the uncertainty out there. Yeah. I've never seen it like this.
No, it is unusual, and I think it's a story of us not being at the epicenter of the storm. I think Trichet, in fact, said today that we're at the epicenter, meaning Europe is at the epicenter in a sense, and it can blow up the equity market, it can blow up the financial conditions indicators, regardless of the U.S. fundamentals in a sense. So we're on tenterhooks in a sense.
Tenterhooks, I like that. Let's look at this note. Peter Bookvar, Miller Tabak with a really extended and sharp note this morning on Greece. The market has done the work. The only thing left for them, the elites, if you will, to be properly marked and reserved for on bank balance sheets. We've got to mark this stuff down. The bottom line here, John, and you did this at Bear Stearns for years, these are the markets talking, aren't they?
Well, they are the markets talking, but marking down is very difficult when you've come to an agreement with all of the banks to take what is a sort of 21% hit on their positions, to then try reopening this at this critical point. Look, all of what we've seen in Greece so far, in my judgment, just pushes the problem down to be dealt with and giving banks hopefully enough time to earn enough money so they can take those write-downs later. Otherwise, we need a grand plan. And a grand plan, in my judgment, can only come about with a Brady Bond-style solution for
I don't disagree with that, but the grand plan, I think we understand in the United States, the grand plan can be done in Washington late at night, talk to the New York Fed, get it fixed. Which institution in Europe can lead that grand plan?
The institutions that are available, and I think those are the ones we need to talk about, because coming up with new institutions in the middle of a crisis is particularly difficult. But I think the institutions that you can think of are really the ECB, which you can think of as the counterpoint is the Fed in the United States, and the EFSF, and I think the counterpoint there was TARP, effectively. And the EFSF can be used for supportive action in terms of recapitalizing banks and the like. It probably is better used in that fashion than supporting sovereign debt.
You two have to keep talking. The markets are getting better. How about Alan Ruskin with us and John Ryding of RDQ Economics? Earlier this morning on Bloomberg Surveillance, I spoke with David Kelly of JP Morgan Asset Management. And looking at everything, Mr. Kelly and I talked about the markets. Here's David Kelly.
Squeeze. It's very simple. It's like you've got the Titanic, and you've got a baseball-sized hole in one compartment under the boat. Instead of doing anything about that hole, they're busy moving all the passengers up to the top decks and ordering new lifeboats. It's crazy. The key thing is to watch European policymakers, see if they can actually make the psychological leap to realize that they've got to do something generous enough to get the Greek economy to grow. If they do that, they can work their way out of this. If they don't, it's going to be a very long, hard struggle.
David Kelly, JP Morgan, talking up the Titanic. Jack, here's a great book on the Titanic, Iceberg Risk, Kent Osmond. This is quant finance. It opens up with the two of them on the front of the Titanic, absolutely sure that they know the certitude of where the icebergs are. Alan Ruskin, where's the iceberg right now?
There's a multitude, unfortunately, including a couple probably we can't see under the Titanic. Just hearing their comments that, hopefully we could somehow engender growth in Greece does not give me a great deal of a hope.
Yeah.
A little bit like you pointed out in terms of your financial conditions indicator. I'd hate to see the Greek financial conditions indicator right now.
Chart, John Ryding, this is in your area more than what Alan's doing every day at Deutsche Bank. An 8 deviation gift. I was stunned by this chart when I made it. Look, that's a gorgeous chart. It's elegant. That orange line at the top is 8 standard deviations from a trend before this debacle. We have made housing affordable, and yet the price theory or microeconomics here is it doesn't matter.
There's a few points on that. Firstly, you've got to be able to get that mortgage. It's not just about the interest rate on the mortgage if you could qualify. That's one problem. But a bigger point is we still have excess capacity in housing, so we can't clear the market till we can get people in those homes, and that puts downward pressure on home prices. And the biggest component of the user cost of capital in buying a house, your true cost, is the fact that if you buy it, say, levered 5 to 1, 20% down payment, and the price is still falling, so let's say the price of houses falls modestly, say 5% over the next year, you've lost 25% of what you put into that house. And so the problem is, when the housing market stabilizes, you take those falling prices out, all of a sudden houses look cheap. But the cost of funding that house is still expensive while you have declining house prices. And so that is at some point there'll be a turnaround. We probably need to create another 2 or 3 million households in this country to get to that point.
That's our unique story. What's the story in Europe? They don't have this housing issue, do they?
Again, it goes country by country.
Really, country by country.
And clearly Spain has got a major housing problem on its hands, really. It's even quite hard to tell exactly what house prices are doing, but they seem to have taken another acceleration downward in price. It's putting additional pressure on the financial system there.
Goldman Sachs calling for economic contraction today in Europe. John, do you have a recession call in the United States?
No, we don't. The current indicators are consistent with modest growth. Now, of course, it's semantics. If you don't have a job, it feels like a recession. We're in a growth recession. We're not growing fast enough to bring the unemployment rate down.
We're skirting a recession at best, really. Underlying growth might be just above 0 for next year.
The heart of my work is compare and contrast, which is a core thing of the CFA curricula, and you guys have been great in supporting us. Bring up this number. We got a special number, folks, off of John Ryding's comment on the commercial break. This is just a great, look at that number. U.S. exports to Greece, 1 billion divided by 15,000 billion. And yet we're all wound up about Greece. John Ryding, the last word to you here, and Alan Ruskin will continue. I mean, it's remarkable the oddity of how small Greece is, isn't it?
It's even within Europe, it's tiny. The issue is it's all about financial risk. It's not about real economic flows.
We're going to come to John Ryding. Thank you so much. Surveillance Midday.